Welcome to this PowerPoint presentation of financial institutions. Bank and credit unions may seem interchangeable today, but there are some distinct differences between them in terms of business purpose, ownership, and governance. Banks and credit unions operate under federal or state charters. Their deposits up to $250,000 are insured by federal agencies, either the Federal Deposit Insurance Corporation, FDIC, or the National Credit Union Administration, NCUA. In other words, money you put in a bank or credit union is insured up to $250,000 just in case the financial institution has business problems. These institutions have many rules and regulations to follow to make sure your deposits are safe. Both institutions are subject to periodic regulatory and federal insurance examination. Your deposits are most secure in these financial institutions. Banks are for-profit business corporations owned by private investors and governed by a board of directors chosen by the stockholders. Anyone can open an account at a bank as long as they have the minimum amount required for a deposit. You pay fees for the use of banking services and interest on loans. They can be community, regionally, or nationally based. Credit unions are nonprofit financial cooperatives owned by their members and governed by a board of directors elected by and from among those members. Usually there is a common bond among the members, such as belonging to the same organization, living in the same geographical area, or they come from a particular business or industry. You can only join a credit union if you are a part of the business, organization, or community it serves. Credit unions accept deposits from their members and use them to make short-term loans. Deposits are regarded as purchases of shares, and all earnings of the credit union are paid out as dividends to members. Usually loan rates are lower because credit unions are nonprofit organizations. Depending on size, all financial institutions usually offer basic banking services, checking and savings accounts, consumer loans, and many offer a fuller range of services, such as credit cards and mortgages. And each has some special features. Banks emphasize business and consumer accounts, and many provide trust services. And credit unions emphasize consumer deposits and loan services. This is one of the safest places for your savings to be. You don't need to worry about theft, fire, or other natural disasters, and your money is insured up to $250,000. When you see the initials FDIC, or in credit unions, the NCUA, you know that the money in your savings is insured. Savings accounts can get you in the habit of saving when you pay yourself first. The statements will also act as a tool for tracking your savings goal. These accounts are used mainly for paying bills. Checks are like writing a note telling your bank to pay a specified amount of money to the company or person who presents the check from your account. ATM and debit card withdrawal are also requests for money to be taken out of your checking account. It is very important that you record all withdrawals as well as deposits in your check register to have an accurate balance. Your check register and statement will also provide you with information on how your money has been spent. It also gives you proof that a bill has been paid. Be sure to keep your account balance accurate. When you write a check or make a debit card transaction for more money than is in your checking account, your check or debit card payment is marked NSF, non-sufficient funds. You will be charged as much as $25 to $50 from your bank, and you may be charged an additional $25 to $50 from the business you wrote the check to. Certificate of deposits earn a higher interest rate than a regular savings account. A higher deposit is usually required to open a CD account, and there is a certain amount of time that you must leave your money in the certificate to earn interest. There is usually a penalty if you withdraw your money early. Money markets also have a higher rate of return, but are not insured by the FDIC. Their accounts can be accessed anytime without a penalty, except in the case of IRA. Some money market accounts require a minimum amount to be in the account and can have a maximum check limitation per month. They also may require that money be in the account at a certain time of the month in order to get interest. Be sure to check all the rules. Most banks have home mortgages, installment loans, and credit cards. A home mortgage is a very detailed process involving your credit report and other personal financial documents. There are steps as well as advantages and disadvantages to home ownership. For more information on home ownership, please contact the Trehab Center's Home Ownership Program. Installment loans are usually used for big items such as cars and a home or home repairs. They are also usually the least expensive way to finance. Credit cards can offer you an easy, interest-free way to shop if your total balance is paid off at the end of the month. If you only pay the minimum payment and carry a high balance from month to month, then you will pay a high interest rate for the money you borrowed to make the purchases. High credit card balance is one of the biggest downfalls for people reaching their goals. If you are carrying a balance on your credit card, pay it off as soon as you can. Automatic teller machine. This is an electronic service that allows you to withdraw cash from your bank. Be sure to record all transactions in your check register to avoid overdrafts. Direct deposit is an electronic service that deposits money directly into your savings account. Many employers can deduct a specified amount from your paycheck and deposit directly into your savings account. If the amount is small enough, you won't even notice it. This is a terrific way to save money. Electronic funds transfer. You can transfer funds electronically by phone, through a teller or an ATM machine from account to account. Electronic benefit transfer. These electronic service allows payments such as Social Security, public assistance to be deposited directly into your checking account. Investment companies are not depository institutions. Investors buy shares of stocks, bonds, or mutual funds with the money they give to investment companies. These companies are regulated by the Securities and Exchange Commission of the federal government. Some allow you to write checks or make ATM withdrawals based on what the investor has already invested. And non-banking institutions? Non-banking financial institutions include check cashing stores, pawn shops, and financing companies. They do not provide depository services like banks do. They often make high-cost loans and cash advances. Their percentage rate generally tends to run high, and they can cost you a lot in fees and interest rates compared to traditional banks and credit unions. This now concludes this PowerPoint presentation.